Why would I want to borrow and pay interest on an IUL, Indexed Universal Life Insurance Policy loan? And I'm going to also answer in this episode, do I have to pay the loans back? Okay. IUL was designed primarily for living benefits, tax-free accumulation of your money and tax-free income. At the end of the day, when you die, this minus that equals zero, and you get the remaining part of the death benefit. That the borrowing method to access money is actually the smartest way to do it. And no, you do not have to pay the loans back, but you can, which is actually an advantage. I'm going to show you how you can reinvest in a grandfathered contract by simply paying back loans you were not obligated to pay back. You can't believe how many IUL agents do not understand what I'm going to explain in this episode. Get ready. So I'm Doug Andrew, and I've been doing this for 5 decades. What's this? It's helping thousands of Americans prepare for a comfortable retirement or other long-term goals, college funding for their kids and grandkids, working capital for business, real estate management, emergency funds, estate planning using what? A properly structured, max-funded, indexed universal life. Now, if you watch other episodes on this channel, or if you've read one of my 12 books about this, what you're doing is you're taking out an insurance contract, an indexed universal life insurance contract, and you're designing it the way that E.F. Hutton, who was the original brainchild behind the emergence of these, for living benefits. IUL was designed primarily for living benefits, tax-free accumulation of your money and tax-free income. Therefore, you should take the least amount of insurance the IRS will let you get away with under certain IRS rules, okay, tax citations. I'm talking about TEFRA and DEFRA. And you put in the most premium the IRS allows as fast as they allow, which is dictated under the TAMRA, the Technical and Miscellaneous Revenue Act of 1988, okay? Now this thing can turn into a tax-free cash cow that will knock the socks off of traditional IRAs and 401ks and so forth. So having said that, I have averaged by diversifying and rebalancing on an annual basis, I have averaged 11.17% and netting over 10% cash on cash rates of return. If you understand rule of 72 math, you take 10% divided into 72, your money doubles about every 7.2 years. Even since 1980, before Indexed Universal Life came out in 1997, go back to 1980, I've averaged 9.62. 9.6 into 72 means your money doubles every 7.5 years, okay? And so if you started out with 500,000, or there was a point in time you had 500,000 in that IUL policy, which many of our clients do within the first 4 years and 1 day, okay? 500,000 can double to $1 million in, 7.5 years. And then that million, if you're not ready to retire, can double to 2 million by the 15th year, and double to 4 million by the 22nd year, and double to 8 million again by the 30th year, okay? Whatever point in time, you take whatever the money is in that policy, and you can pretty much get a 10% payout if you do it the smart way without depleting principal. So when I have written my books ever since my very first one called Misfortune, I usually explain it this way. You can access money out of an IUL one of 3 general ways: the sad way, the dumb way, and the smart way. Okay, the sad way is by dying. Now, it's one heck of a return, but I don't recommend that. But if you happen to pass away and you've only put in 10,000 or 100,000 and the death benefit's $1 million, your heirs are going to get $1 million tax-free. That's one heck of a return, but you had to die in order for them to get it. But that's the death benefit. That's the advantage. But if you're using it for living benefits, then you want your money to grow tax-free and then start accessing tax-free income. So let's just take an example of $1 million of cash value in an IUL policy. You got $1 million in there at a certain point in time, and now you want to take out income, okay? Now, you could take out money for an emergency or to buy a piece of real estate or whatever, but let's say that you're doing it for income, and now you want a consistent income. Now, you can actually pretty much assume that you could access 8% in a payout. So 8% of $1 million in a IUL would be $80,000 a year. If it's structured correctly and funded properly, and you're earning 9.6, and you pull out 8, it's not going to deplete the principal. That's a no-brainer. Okay. So if you're earning 9.6, you're going to be netting 8.6. If you're only pulling out 8% a year, your cash value is probably growing in spite of you taking out the money. Okay. Now you could just withdraw 8% or 80 grand a year, but that's going to permanently reduce down the size of the policy and the death benefit, and also the ability to put money back into the contract. So that's the dumb way to take out money. But basically, the IRS says that with permanent life insurance, cash value life insurance, you can access all of your basis. Okay, what's your basis? That's the amount of premiums that you paid into the policy during the life of the policy. Okay, you can get all of your money back out that you paid in without paying tax. That's tax-free because it's taxed FIFO, first in, first out. Most investments are not taxed FIFO. Annuities and what have you are taxed LIFO. The last money you're earning every year, the interest, is coming out first. And so you're paying tax every year on 100% of what you're taking out, unless you're dipping into the original basis or your principal. And that's the beauty of life insurance. It's taxed FIFO, first in, first out. So you could be pulling out money out of your policy, and let's say you put in $500,000, and you're taking out 10% a year of $500,000. That's 50 grand a year. It would take 10 years, in that simple example, for you to recoup the $500,000 you put in. That's tax free. But then if you kept pulling out $50,000 a year, now you're into your growth, starting the 11th year in that example, and you have to pay tax. That's dumb. Okay. You don't have to do that. You would switch the nomenclature to a loan. You're going to borrow money out of the insurance company or the policy, so to speak. And people say, well, why would I want to borrow my own money? Why would I do that? And they don't understand how money works. First of all, that's what it tells me. So let me explain this. If you borrow money from anywhere, a bank, a credit union, or whatever, to buy a car or for your business or whatever, do you have to pay taxes on the loan proceeds if you borrow money? No, it's a no-brainer. You don't pay tax on loan proceeds. So you borrow from the insurance company using your cash value in your insurance policy as collateral, okay? And you can be borrowing the equivalent of the interest they're crediting you. So let's go back to the example. You've got $1 million of cash value in there. And let's say it's earning 8%. So you could borrow $80,000 a year. And now you could do that forever, even after you've recovered your basis. And it's tax-free because you're borrowing the money out. You're borrowing the equivalent of your interest. And so there is no tax due. And that would be smart. And so if you do that, and you feel like, oh, golly, the economy is not going to do well. I don't care about having my index credits on my policy. If you are a doomsdayer and you think that's what you want to do, you can use what is called a zero wash or zero cost loan. So when people say, why would I pay interest? Well, you don't have to make out a check and pay the interest. The interest is accumulating on what I call a phantom loan. So you borrow $80,000 from the insurance company using that $1 million of collateral, and that $1 million is earning 8%. It's earning $80,000 that year. So the policy earned $80,000 in interest, and you borrowed $80,000. And so if you're borrowing on a zero-cost loan, the insurance company is simply going, okay, so you have this $80,000 phantom loan balance. And this loan, we're going to be charging you, let's say 2%, okay? So they charge you 2% interest on that $80,000 loan, but on the $80,000 that you use to collateralize that loan, they are going to credit you the same 2%. So if you understand what I just said, the insurance company on their ledger is charging you 2% on the 80,000, and they're crediting the same 2% interest on the 80,000 that they set aside as collateral. They charge you 2, they credit you 2. What's that? A net of 0. It's a zero wash, zero cost loan. Doesn't cost you anything. Why would you do that? The loan balance continues. Let's say every year you pull out 80,000. Now the next year you got $160,000 loan balance accruing at 2%. But see, now you have $160,000 of cash value that is also accruing at 2%. And so they equal each other. You could go 20 years pulling out $80,000 a year. And you do that. That's 800,000 times 2 10-year periods. That's $1,600,000 that you have with interest in phantom loans. But you also have $1.6 million in that collateral that's also growing at 2%. At the end of the day, when you die, this minus that equals 0, and you get the remaining part of the death benefit that, the original death benefit that you had in the policy. It's the same as if you withdrew it the dumb way and paid tax after you recovered your basis. Why would you do that? So the zero wash loan doesn't really cost you anything, but you borrow it to make sure that when you take it out, it's tax-free. So far, so good? Okay. Do you have to pay the loans back? No, but you can, and you're going to see why that's an advantage here in just a moment. So it's a phantom loan balance. It's washed away when you die. Now, that's not the way that I borrow money, and the vast majority of my clients are savvy. They're business owners. When the economy is normal, okay, they might use a zero-cost loan during a recession. But during normal times, my clients use what I use, and that's what is called an index loan or a participating loan or alternate loan. Now, listen very close. What's the difference with an index loan? I'm going to refer to it as an index loan, but different carriers call it different things, like a participating loan or whatever. That means that when you take out the money in the form of a loan, they will charge you a higher interest rate. It could be 4% or 5%. Let's use 5%. Now, immediately they say, well, why would I have the insurance company charge me 5% when they'll charge me only 2% on a zero-cost loan? Well, a zero-cost loan, they charge you 2, but they only credit you 2. If they're going to charge 5% on an index loan, they will credit me not on just the collateral, but on my entire cash value, including the collateral for that loan. If I have $1 million and it's actually earning 10%, then yeah, I'm earning 10%, but what they're doing is they're crediting me on my full $1 million. They don't carve out the portion that's collateralizing the loan. They credit me the indexed rate. The indexed rate, some years I've been credited 25%, 61.33%. But let's say it averages 10, okay? So if they charge me 5% and they credit me an average of 10%, how much more is 10 than 5? Don't say 5. It's 100% more. Would you hire an employee for 50 grand that made you an extra 100 grand? Would you buy a widget machine for 50 grand that made you an extra 100 grand? That's called a 100% return on your employment cost or the cost of borrowing, okay? So let me make this clearer. I had a client in 2017, business owner, savvy, smart. He understands how money works. He had an index universal life policy. He's borrowed on it many times for his business. Now, so in 2017, he needed $1 million. He needed to take some money to buy a strip mall and fix it up and flip it. And he needed some earnest money, $1 million of earnest money. He contacted me, Doug, I need to borrow $1 million out of my IUL. Now, he's done it many times. He said, send me over the form. It's a one-page form, okay? And he puts his name and his policy number on this form, and it says, do you want to withdraw $1 million out of his policy, okay? No, he didn't check that one. It said, well, do you want to borrow $1 million from us, the insurance company, using cash value as collateral? Yes, he checked. And then it says, which one do you want to use? Do you want to use the 2% zero cost loan, or do you want to use the index loan? Which one do you think he checked? The index loan. So in 2017, he borrowed $1 million out of his IUL policy, but it was really not out of his IUL policy. He borrowed it from the insurance company. And they loaned him $1 million because he had at least $1 million of cash value in his policy. They charged him 5%, a higher rate. 5% on $1 million that year was 50 grand. He doesn't have to write out a check. He doesn't have to pay it back. They don't worry about it because 50,000 of interest is deducted out of the money that is being credited on his full $1 million that he didn't withdraw, okay? Guess what he got credited in 2017 on that $1 million that was collateralizing his loan? He got credited 25%. He capped out. Hello? They credited him $250,000 tax-free on the $1 million of cash value that he didn't withdraw. He borrowed using that $1 million as collateral. They credited him 250 grand minus the 50 grand of interest. He netted 200,000 tax-free, 20% on his $1 million while he was technically using it to buy, fix up, and flip a strip mall and make $3 million. He made $3 million there, and he continued to make a $250,000 of interest on his $1 million that he technically left in the insurance company, only borrowed against it. Does that make sense? If you don't understand this, you're going to miss the boat. So let's come back. If we had a client that was only even earning 8% on an average index rate, not 10%, on $1 million of cash value, my clients have been able to pull out a 10% payout, okay? 100 grand a year, even if they're only getting credited 8%, without depleting their nest egg. When I say that, people go, wait a minute. Your clients have $1 million of cash value, and if they only earned or got credited 8%, they can actually pull out 10%? Yeah, 100 grand and not deplete principal. What? How? By using the index loan. See, because the average client is making up that extra 2% by borrowing out, let's say with an index loan at 5%, and all they have to do is average 7 or 8%, okay, which is a piece of cake. So they make the extra 2% arbitrage on top. And so they're able to pull out 10% a year without depleting principal because they're pulling it out the smart way. They continue to earn or get credited on their policy at 2% or higher than the borrowing rate. And so they're able to pull out that extra 2%. They're able to pull out a 10% payout, 100 grand a year, without depleting their $1 million nest egg. Now, if you don't get it, oh my heavens, you're going to miss out. So this is the smart way, and that's why I use index loans, because generally speaking, during the years that the economy is doing well, you will average at least 2 or 3% higher crediting rates than the actual borrowing rate. This is how money works, okay? So that's why you want to borrow. It's tax-free. You don't have to write out a check and pay interest. People say, why would you do that? Because it's not costing you anything. It's making you money. You're borrowing out at a lower rate, or even borrowing out at 2%, and you're being credited the same 2%. It doesn't cost you any interest. It's either a zero wash, or else you're going to make more than what they're charging you over the long run. Now, yeah, some years you could borrow at 5 and be credited 0. But when you average it out, most people are way ahead by using the index loan. Now, let's come back here to this question. Do I have to pay the loans back? No. It's a phantom loan balance. It just accrues. It's going to be washed away with the money that is being credited on your account because you have this loan balance and you have the cash value balance. So this minus this equals the death benefit when you ultimately die. It's washed away when you die. But get a load of this. Doesn't mean you can't pay it back. Well, who would want to pay it back? Let me use an example. I've had clients who, let's say they've been pulling out 100 grand a year out of their $1 million of cash value from age 65 to age 85, okay? 20 years they've been pulling out 100 grand tax-free, and they still have $1 million in their policy, okay? And yeah, they got this phantom loan and everything, but it's been great. And all of a sudden, this 85-year-old gets a windfall. They sell an asset. They inherit money, okay? Whatever. I've had people in their 60s and 70s that come across a lump sum of money from an inheritance, an automobile accident settlement. They sell their business or some asset or whatever. And they come to me and they go, Doug, I have $2.5 million. I have $3 million What should I do? I'm too old now to start a new IUL policy. Should I take one out on our adult children and they can own it? Yeah, you can do that. Golly, I wish I could open up another one of these myself, but the tax laws have changed, or I'm too old, or whatever. And I say, you're in luck. Why? Because you already have one. Yeah, but I maximum funded it. Yeah, but you've been borrowing money out of that policy for 20 years. You had this, you've taken out $2 million, $100,000 a year for 20 years. You've taken out $2 million. And the interest on that for 20 years is let's say another $1 million. Okay. You have a $3 million phantom loan balance over here on your policy. Now, of course, you have $4 million of actual cash value because it's been growing way faster than this. You might have 4 or 5 million or whatever. Okay. But see, this is a phantom loan. You don't have to pay it back. It doesn't mean you can't. All of a sudden, the light bulb goes on and I go, you've got $3 million. You could pay back all of those 20 years of loans plus interest. You could put $3 million. The insurance company is deeming it, new money. You're putting in $3 million of new money into a policy. The IRS says you're paying back a loan. You're paying back a loan that you weren't obligated to pay back, but you did it. The insurance company goes, oh, here's $3 million of new money. That $3 million is added on top of the $5 million that you had accrued. Okay. Now you have $8 million minus the phantom loan balance now you don't have a phantom loan balance anymore. You hit the ground running. Okay. You actually paid back a loan. So technically speaking, if you had $5 million of cash value and a $3 million loan balance and you pay off the $3 million loan, now you have $5 million of actual cash in that policy is what I really mean. Before you only had a net of $2 million because you had this loan balance that would be subtracted if you died. Now you hit the ground running. You put in $3 million, you pay back all those loans in one fell swoop, and now that extra $3 million can generate an extra $300,000 a year of tax-free income instantly at the same 10% payout on top of, what you were doing before. So now you have $300,000 on top of the $100,000. Now you have $400,000 of tax-free income because you were grandfathered to be able to reinvest by paying back loans that had been accruing on a policy that you weren't obligated to pay back. If this is blowing you away, I understand. But you can't believe how many insurance agents do not understand what I just explained on this episode. If you want to learn more, study my book, The Laser Fund, okay? Now, you simply click on the link below, or you can go to laserfund.com and contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, but I require a little bit of skin in the game. But I'll pay for this 300-page book, and I'll fire out a hard copy to you via priority mail. Now, it's actually 2 books in one. There's 200 pages, 14 chapters of the left brain side with charts and graphs. If you're more into stories, you're a right brain learner, you flip it over, and this is 100 pages, 12 chapters with 62 actual client stories. Or you can use your whole brain and read both, okay? Now, when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats. You can also register for free educational webinars. We teach a weekly webinar that is about a 90-minute educational session. Once a month, we do a 6-hour Retire by Design. These are here for you to learn. There's no cost or obligation, but you can also schedule an appointment with a certified IUL specialist with no cost or obligation that can show you how these strategies can work in your particular set of circumstances with your numbers, okay? So take advantage of it. Claim your free copy of the book now, and I'll see you on the other side of your brighter future.